Good morning, good afternoon, good evening. Let us start international capital budgeting again. So we will take two very important questions now. You have to write down the questions. Please write one important question which was not asked in exam or in RTP, taken from other reference book. So please write down. An American manufacturing company wants to establish a project in Wuhan, China. An American manufacturing company wants to establish a project in Wuhan, China. Initial outlay is USD 120 million. Initial outlay is USD 120 million. So this is my initial cash outflow, 120 million. Annual cash flow in bracket in Chinese yuan for the next 5 years are, annual cash flow in Chinese yuan for the next 5 years are dash 200 million, 350 million, 300 million, 250 million and 150 million. Full stop. Continue. At the end of 5 years, the project would be wound up. At the end of 5 years, the project would be wound up. The desired return is 15% in USD terms. The desired return is 15% in USD terms. Next line, in respect of project investment by foreign companies. In respect of project investment by foreign companies, the Chinese laws restrict repatriation to 10% of the project investment. The Chinese laws restrict repatriation to 10% of the project investment for each of the first 3 years. The Chinese laws restrict repatriation to 10% of the project investment for each of the first 3 years. Underline this sentence. Next line, first we'll write down the question. The foreign company's share in the cash flow. The foreign company's share in the cash flows in excess of 10% of the project investment. In excess of the 10% of the project investment should be invested in 6% tax-free government of China bonds. Should be invested in 6% tax-free government of China bonds. The bonds will mature at the end of the third year. The bonds will mature at the end of the third year. The bonds will mature at the end of the third year. Next line, the spot rate is USD 0.1250 per yuan. The spot rate is 0.1250 per yuan. The yuan is expected to appreciate by 10% every year for the next 2 years. The yuan is expected to appreciate by 10% every year for the next 2 years. So first 2 year appreciate and depreciate 3% every year thereafter, and depreciate 3% every year thereafter. So point number 1, evaluate the project. Evaluate the project from the American company's perspective. Evaluate the project from the American company's perspective. And second question, would there be any change? Would there be any change if the 50% of the project, is financed by a Chinese firm? If the 50% of the project is financed by a Chinese firm, so this will become a 50-50 joint venture. So accordingly, all calculations will change. First question, evaluate the project from American company's perspective. I am sure you have written the question. Now let us read it. American company wants to establish a project in China. The total project cost is 120 million. And that will be required here when it says that only 10% of the project investment can be repatriated for the first 3 years. So 120 million USD will convert into its equivalent amount in yuan. That amount can be repatriated. Then 5-year cash flows are given. Life is 5 year. Discount rate 15%. In the first 3 years, only 10% of the project investment can be repatriated, which means 90% cannot be repatriated, and that will remain invested in China for 3 years in 6% tax-free government bond, and after 3 years this amount will be released. Then you are given the spot rate, yuan appreciation rate for 2 years, and then depreciation rate for 3 years. So first question is, assume that 100% investment is made by American company in China, and in second question assume 50% is financed by a Chinese firm and 50% is financed by American company. So in that case their share in the revenue will also be 50% and their investment will also be half of this. So problem has to be solved twice. One by assuming 100% of the project is invested by American company, and second case 50% of the amount is invested by American company. So answer will change slightly, of course. So first step 1, which is going to be a common working note for both the answers. Please write down step 1, forecast of exchange rate. Forecast of exchange rate, 3 columns, year, calculation, expected spot rate. Expected spot rate in bracket USD per yuan. Yuan is the currency of China. First year write down, you are given 0.1250 USD per yuan, and yuan is appreciating by 10%. Rate is per yuan, yuan is appreciating by 10%. So directly multiplied by 1.10 or plus 10% or into 110%, whatever suits you. So the answer is 0.1375. Then in year 2 again the yuan will appreciate by 10%. So 0.1375 into 1.1, 0.1513, and thereafter next 3 years yuan is expected to depreciate by 3% per annum every year. So take this answer, 0.1513 into 0.97, that is 0.1468. Keep checking the answer. Fourth year again take this rate into 0.97, that is 0.1424. Take this rate into 0.97, 0.1381. So if you present it neatly, easy for you to revise. First 2 year yuan appreciates by 10% and the next 3 years yuan depreciates by 3%. Okay. Now we'll come to step number 2. Initial investment in yuan. Initial investment in yuan. Initial investment in yuan. Using the spot rate, we will check how much was the initial investment in yuan. Serial number, particulars, amount in million. Very easy, nothing to explain. Point number A, initial investment in USD. This American company had invested $120 million. What is the equivalent amount in yuan? So for that we'll apply the spot rate USD per yuan, which is given in the problem, 0.1250. This amount is in USD and the rate is per yuan. Therefore, we'll divide. So the answer is 960 million yuan. You will require this number because 10% of the project cost, so this is the total project cost in yuan, can be repatriated in the first 3 years. So now write down step number 3. Step number 3 actually, present value of annual repatriation. Present value of annual repatriation. Figures in million. Figures in million. First 3 year we can only repatriate 10%, then we can repatriate the entire amount. Format you know now, you have become a pro now, professional. Year, cash flow in yuan, cash flow in yuan. Third column, maximum amount repatriable in yuan. Maximum amount repatriable in yuan. Then exchange rate, dollar per yuan. Exchange rate is dollar per yuan. Maximum amount repatriable in dollar. Maximum amount repatriable in dollar. And the last column is present value at the rate of 15%. Keeping a gap of one line, write down year 1, one line blank, year 2, 3, 4, 5, like this. Always keep one line blank. Cash flow in yuan is given. Cash flow in yuan is given 200, 350, 300, 250, 150. How much amount can be repatriated? 10% of the project cost. Project cost is 960. So 10% of that, 10% of the project cost, 10% of the project cost, that is 960 into 10%, 96 can be repatriated in the first year, second year, third year. The restriction is only in the first 3 years. Then there is no restriction. Then there is no restriction. Restriction is only in the first 3 years. Thereafter you can remit your entire cash flow to USA. So 250 and 150. This is full. Now only remember, whatever is not repatriated, the balancing amount, will prepare a separate working note where the difference will be invested in a Chinese bond which will earn 6% interest, and the maturity value of those 3 bonds at the end of 3 years will then be repatriated to USA. Right. Now write down the exchange rate. This already we have calculated in step 1. So in the bracket you can write step 1 for reference. Go to step 1, 0.1375, 0.1513, 0.1468, 0.1424 and the last was 0.1381. Please write down rates. Now my job is almost done. Your job starts. This is 96 yuan and this is dollar per yuan. Amount is in yuan, rate is also per yuan. So we'll multiply and we'll get the amount in dollar. So please multiply. First three number do like this, 96 into 0.1375 equal to 13.2. Now just press 0.1513 equal to, you will get 14.525. Just press 0.1468 equal to 14.093. Then you have to multiply 250 into 0.1424, 35.6. And the next one, 150 into 0.1381, 20.715. 20.715. So now what you do, calculate the present value at the rate of 15%. Calculate the present value at the rate of 15% and take the total. This is classwork for you now. Calculate present value at 15% and take the total. Try yourself. I want you to learn the calculation part also, because that is where students can commit mistake in the exam. So try yourself. We'll check the answer in next few seconds. We'll check the answer. Take total also. A good student will use memory plus function also. All 5 numbers. We will only check the total. Keep trying. Keep trying. Okay, now check the answer. Check the final answer. Approximately check. Are you getting something around 62.39, something close to that number? If yes, let us go to the next calculation. What is pending? Those amounts which were not repatriated will be invested in Chinese bond, earning 6% interest. After 3 years, we'll get a lump sum value, and that will be repatriated to USA by applying the 3rd year exchange rate and also doing the discounting at 15%. So next step number 3 will be present value of blocked funds. Present value of blocked funds. First 3 years, some amount were not remitted, they were invested in China. So first we'll calculate their future value and then again discount it at 15%. So write down one small table with 5 columns. First column write down year. Second column cash flow in yuan. Third column maximum amount repatriable in yuan. So total cash flow minus what we have repatriated. Balance amount is 4th column, amount invested in government bond. Amount invested in government bond. Amount invested in government bond, and then future value, that is the future value of this bond at the end of 3rd year. So the formula to get the future value, write in bracket present value into 1.06 to the power n. Present value into 1.06 to the power n. Now write year 1, 2, 3. If you can keep one line gap, I'll be happy. First 3 year cash flows were 200, 350, 300, and then the repatriation was 96, 96, 96. So what is the amount not repatriated? is invested in government bond, 200 minus 96, 104, 350 minus 96, 254, 300 minus 96, 204. And now you invest it. The first bond will be invested for 2 years. So apply 2-year interest factor. 1.06 into equal to multiplied by 104. So that will give you 116. Then just take 254 into 1.06. The second bond will earn interest for 1 year. So that comes to 269.24. The third bond will not earn any interest. You have invested at the end of third year. You are withdrawing at the end of third year. Where is the interest? Take the total. This much yuan you will get. This is yuan. This many yuans you will get after 3 years. So what is the next task now? The next task is first convert into dollar and then apply the present value factor. So right below the table, converted into US dollar. Converted into US dollar, 590.094 multiplied by the exchange rate of the third year, 0.1468, and that is equal to $86.6258. Can you see that? $86.6258. Now you discount it by 3-year factor. So please write down present value of 86.6258. You can write 86.6258 equal to, take this number, divide by 1.15 to the power 3. So how to get on your calculator? Type this number, divide by 1.15, 3 times equal to, are you getting $56.96? $56.96. So this is the amount we will receive from repatriation of the amount which was invested in Chinese bond. So now we have got answers ready. We have got the initial investment amount. We have got the cash flow of repatriated dollar. We have got cash flow of blocked fund also. So bring them together and check what is the net present value. So my step number 4 will be NPV. First 3 working notes will bring together now. That is working note number 2, 3 and 4. Calculation of NPV, step number 5. This is step number 5. Calculation of NPV. Serial number, particular, step number, amount in million. Serial number, particular, step number, amount in $1,000,000. All figures are in dollar. So serial number A, initial investment in USD. Step number 2, 120. B, PV of repatriated US dollar. Step number 3, PV of repatriated US dollar. Step number 3, 62.3912. 62.3912. Point number C, PV of blocked funds. PV of blocked fund. 4. Step 4, previous step, 56.96. Therefore NPV A plus B plus C. Add these 3 numbers. First one is negative. Your total is 0.6488. Very close shave. Just $1 here or there, and negative can become positive. So even though it is a very close number to 0, because we are the student, we have to write based on the number that I got. It is a negative amount. So as the NPV is negative, as the NPV is negative, the project should not be accepted. As the NPV is negative, the project should not be accepted. So this is case 1. In case 1, 100% amount were invested by American company. In case 2, 50% amount will be invested by the American company. So their share in the cash flow will also be 50%, and accordingly calculations would change. Case 2, write down. Case 2. Case 2 is 50% of the project is financed by Chinese firm. 50% of the project is financed by Chinese firm. Under that step 1, initial investment in yuan. Initial investment in yuan. Exchange rate we will not calculate again, because exchange rate will not be affected because of the investment. So one working note is common for both the cases, exchange rate. Step 1, initial investment in yuan. Serial number, particulars, amount in million. This time we are going to invest only 50%. So point A, write down initial investment in USD. Initial investment in USD. Half of what you had written earlier, 120 by 260. 120 by 260. And point B, spot exchange rate. Spot exchange rate is USD per yuan 0.1250. 0.1250. Then point C, initial investment in yuan. Initial investment in yuan, A by B, 480. Initial investment in yuan, A by B, 480. Just multiply 60, not multiply, divide. 60 divided by 0.125, because this is dollar, this is per yuan. So you need to divide here 480. Now the remaining 2 working notes again will prepare in the same manner, but this time the share in cash flow will be 50%, not 100%. So accordingly the amounts will change. So please write down step number 2, PV of annual repatriation. PV of annual repatriation, figures in million. Figures in million. Year. Draw this table, 6 columns, year. US companies share in cash flow. US companies share in cash flow, in bracket yuan. Maximum amount repatriable in yuan. Maximum amount repatriable in yuan. Maximum amount repatriable in yuan. Exchange rate. Exchange rate, dollar per yuan, same format. Maximum amount repatriable in dollar. Maximum amount repatriable in dollar. And last column, PV at the rate of 15%. Draw columns. If you have scale, draw lines properly. Keep a gap of 1 line after each year. 1, 2, 3, 4, 5. US companies share in cash flow, half of what we have written earlier. So cash flow in year 1 from the project will be 200. US companies share will be 100. Then second year was 350. Divide by 2, 175. Third year was 300. Divide by 2, 150. 250 divided by 2, 125. And 150 divided by 2 is 75. I hope this is understandable. Maximum amount you can repatriate. Now here we have 2 possible answers. One answer can be, we will take 10% of 480. That is only the share of US company. The second answer will be the interpretation of the problem. The problem says 10% of project cost can be repatriated. So project cost is 960. The project cost is 960. So if I apply the interpretation as per the question, they have not mentioned 10% of the amount invested. They have said 10% of the project cost. So I will take in this answer also 10% of project cost, that is 10% of 960 here for the purpose of repatriation. So repatriation restriction is only in the first 3 years. The repatriation restriction is only in the first 3 years, and then you can repatriate your entire share in the 4th and 5th year. So restriction only in first 3 years. Restriction only in first 3 years. Okay, subject to 10% of project cost. So this you have to mention somewhere for your understanding. Purposefully they give such question because you might just keep writing 96, 96, 96, etc. So very carefully you have to read the problem. These are practical questions in real life situation. This way the agreements are drafted keeping in mind the local regulations. Okay, so now I think my job is almost done. These 3 columns you can also complete. First, copy the rates again. Copy the rate from step 1 of case 1. Same rates copied. Now convert into dollar. I think first 3 figures you can copy from previous answer without putting effort. And then you have to multiply 17.8. This is 10.358. Calculate the present value. Calculate the present value yourself and tell me the total. I am sure you can do faster this time because first 3 years are same figure. So if the first 3 years figures are same, you can do it. So start solving please fast. Calculate the present value in the last column. All of you try. Yes, keep trying. If you want, you can copy the first 3 figures from previous case 1. If you think that the figures are same. And last column take the total. Last column take the total. Now we'll check the answer. Last column total we will check. If the total is right, more or less you are right. So the total is approximately 47.0631. 47.0631. One more step 3 is required where we will calculate the present value of blocked funds. The amount will be different this time because our share is only 50%, not 100%. So therefore the amounts will change. The answer will change. Same 5 columns, same format we will follow. Year, cash flow in yuan, amount repatriable in yuan, maximum amount repatriable in yuan. These 2 columns already calculated in the previous answer. Therefore amount invested in Chinese government bonds. Amount invested in Chinese government bonds. And the last column future value equal to present value into 1.06 to the power n. Draw lines. Take a scale, draw lines, keep one line blank after each year. Only 3 years because the restrictions were there only in the first 3 years. write down cash flow total. Go to previous step 2. In previous step 2, calculate the share of American company in the cash flow. Just previous step 2. You will find there 100, 175, 150. And previous step, go to previous step, check the amount repatriated. The amount repatriated is 96, 96, 96, 10% of the total project cost. So the remaining amount will be reinvested in Chinese government bonds. 4, 79, 54. And this will earn 6% interest per annum, annual compounding. So multiply 1.06 into equal to into 4, 4.4944. 79 into 1.06, 83.74. Last one will not fetch any interest, 54. Total of the last column, try. Total of the last column, yes, 142.2344 approximately. 142.2344. This is in yuan. You will convert into dollar. Then you will convert into present value. So step number, next write down below that, converted into dollar, 142.2344 into 0.1468. So you are getting $20.88, but this amount is after 3 years. So below that write down present value of 20.88 is equal to 20.88 divided by 1.15 to the power 3. Check the answer, $13.7289. First check, then write. So this is my cash flow of the blocked fund. Initial investment we have, PV of repatriated funds and PV of blocked funds. So step number 1, 2, 3, bring it together, you will get the NPV. So serial number, particulars, amount in million, calculation of NPV, and one more column I will add here, step number. So first write down serial number A, initial investment in USD. Step number 1, amount is 60, outflow. B, PV of repatriated USD. PV of repatriated USD. Step 2, go to step 2, write 47.0631, very easy. Point C, PV of blocked funds. Step 3, just now we have done 13.7289. 13.7289. Point number D, NPV. NPV is equal to A plus B plus C is 0.792. 0.792. Now write down one note. As the NPV is positive, the project should be accepted. So this time my answer is positive NPV. And these are all numbers very close to 1 or 0. So you have to be very careful with the calculation. A small mistake in calculation can make it negative. As the NPV is positive, project should be accepted. Positive NPV increases the wealth of the shareholder. Positive NPV increases the wealth of the shareholders. positive NPV increases the wealth of the shareholders. And one more note, write down. One more note. In case 2, it is assumed that amount of repatriation will be 10% of total project cost. This answer is now over. So this is one important question we have completed. Read the problem carefully. Is it 10% of total project cost, 10% of the amount invested? Accordingly, your answer will change for case 2.